Can you first brief us on what you guys do at Breakout Capital Advisors?
We are a emerging markets, public equities, long biased investment firm, and our clients are mostly financial institutions from all across the world. That includes sovereign wealth funds, endowments, pensions, those kind of things.
So you became a unicorn in assets.
Unicorn in assets for now, and we'll take it with both hands.
So let's go to the flavor of the season, which is America. What percentage should America occupy in a global portfolio?
So there is the MSCI All Country World Index, which is known as the ACWI.
Yeah.
Where US weight is somewhere between.
And you don't take money from retail investors, right?
We don't.
So how rich would I have to be able to invest in?
So I think the minimum ticket size that we do is.
Hello and welcome to the Global Investing Podcast. I'm your host Neil Borate. Joining me today is Swanand Kelkar of Breakout Capital Advisors. He's managing partner there, and of course he was earlier managing director at Morgan Stanley. He's also famous for having taken a sabbatical and done many interesting things during that time. So Swanand, welcome.
Thank you, Neil. It's a pleasure.
It's I think one of your few and rare appearances on camera, so we are privileged to have you.
Yeah, thank you. I wouldn't have done it for anyone else. Let me say that.
Thank you so much. So Swanand, can you first brief us on what you guys do at Breakout Capital Advisors?
Sure. So maybe I'll give a quick rundown. So Breakout Capital was started by Ruchir Sharma, who was my boss at Morgan Stanley, and myself about 3 years ago. We started off in June 2022. What Breakout does is that we are a emerging markets, primarily an emerging markets, public equities, long biased investment firm, and our clients are mostly financial institutions from all across the world. That includes sovereign wealth funds, endowments, pensions, those kind of things. We also recently started an India dedicated fund as well, which invests only in Indian stocks. So a combination of these two, we just crossed $1 billion of assets. So very happy about that. So
you became a unicorn in assets.
Yeah, I wish that eventually it becomes a revenue as well, and then valuations. But unicorn in assets for now, and we'll take it with both hands.
And you don't take money from retail investors, right?
We don't. So for now, I mean, that's been our DNA even at Morgan Stanley, that we were predominantly an institutional investor in the sense that we used to take money from other institutions. So I think the retail DNA was never part of what we did at Morgan Stanley.
So how rich would I have to be able to invest in?
So I think the minimum ticket size that we do is $5 million. That's mostly for friends and family. But we do not have any structure in India. So all the money comes through either an offshore structure in the US or one onshore in the States. So in India, we are also still trying to figure out how do we get some money from our friends and family in India and invest in the fund.
Yeah, अपने देश के लिए कुछ करना चाहिए.
I agree with you.
Alright, Swanand. So let's begin with the big question that most Indians who are aware of global investing have, which is where do you actually invest the money? How do you allocate it between different geographies? So if you can first give us a framework for allocation across markets.
I think that's a good question. I mean, this was probably not a question even 3 years ago that people were very interested in, right? When the Indian markets were in a sort of a one-way, rara bull market happening. But I think I get this question a bit more frequently these days, and thanks to people like you who have been talking about global and international investing for a while now. I think the first question is an important one, that how much should you put into global assets? I think there's no set answer. Sorry to disappoint you on that. But I think the two ways to look at it is, if you have a dollar outflow in the foreseeable future, I think you should try and get to that corpus. And that dollar outflow is typically either children's education, or maybe in some cases even a vacation or a medical expenditure or whatever. So if you want to get to that dollar asset without having to take the currency risk, I think that is the number you should start working with, that I need to reach an X number in X number of years. Personally, about 20% of my equity allocation is in international equities. But I would say I am not the median investor, because I sit in what I think is one of the best emerging markets investing teams. So I get to hear a lot of these things on a regular basis. So this is my day job. So I'm in the thick of things, which is why my allocation is about 20% of my equity allocation is in international equities. But for
you want to insulate yourself from, since you do it day in and day out, you want your portfolio to be outside that construct.
Correct. That is one part. But the important part is that I keep abreast of all these things on a fairly regular basis, because that's my day job. Right? So if you invest, let's say, in Poland or Brazil, most likely as a lay person in India, you will not get enough feed to know about what's happening there, why it is happening, etc., which, given my day job, given the firm that I work for, I keep listening on a daily basis. So that is one part. If you're starting out new, I would say take baby steps. Second, just to give you a rule of thumb, don't go more than 10% of your equity allocation in international very quickly. Because normally what happens is, if you're a new retail investor getting into it, generally the flavor of the season is what gets peddled to you. So you want to take baby steps, and to limit the amount of equity exposure that you have, which is international.
So let's go to the flavor of the season, which is America.
Yes.
What percentage should America occupy in a global portfolio?
So let me start with where the neutral weighting is, right? So there is the MSCI All Country World Index, which is known as the ACWI, where US weight is somewhere between 65 and 70%. Right? This is at an all-time high. It has gone up steadily over the past, I would say, decade or so. So any global asset allocator today has to have, if he wants to be close to the benchmark, will have 65 to 70% of his or her asset allocation in the US. Emerging markets all put together is less than 10. India is about 2, right? So that's where the lay of the land is in terms of how people institutionally are allocating money. That does not mean you have to do the same thing. I have a bit of a contrarian streak in me, which is why I feel that the US has been the only game in town, so to speak, for the past decade or so. So I would not want to invest as much as the index is invested in the US. So should that number be 40%, 30%, 20%? I think it's an individual call. But what has happened over the last, I would say, 12 odd months is the fact that other parts of the world are showing a bits of life, showing some signs of life, which is basically emerging markets, even developed Europe, for that matter, Japan in parts. And I would have a larger allocation there than what the neutral or the index weight is at a very broad level. But US is the place where you get the most, sort of the widest array of investment options via ETFs, via listed stocks, some 4,000 odd listed stocks, maybe an equal number of ETFs, if not more. So I think by default, by the availability of options, you tend to invest there.
Of course, through the US, you can invest in ETFs that in turn track Europe or Latin America, right? So that's just the domicile of the instrument. But let me just conclude the US part by asking, there is a story of the Mag 7 driving the US stocks higher and occupying a huge weight in the US market. What is your take on that debate, Mag 7 versus rest of the US market?
So there's this whole dichotomy between S&P 7 and S&P 493. Right? There are these 7 stocks which are probably driving the entire US markets. Mag 7 at one point in time were about 35% of the, I think they would still be in the same ballpark, about 35% of the S&P 500. And those are the ones that are pulling in the most money, right? So even within US, which is a fairly large market, large economy, the rally or the stock performance has been very, very narrow, right? If you look at the Mag 7 versus the other stocks, nothing has happened there. So not only there are 2 levels of lopsidedness here. One is the fact that bulk of the money has gone to the US, and within US it has gone to these 6-7 stocks. I come back to the same point. If you have some sort of a contrarian streak inside you, you should try and do the other side, right? But this is a very, very, absolutely, either the 493 or the rest of the world. But that 7 is where bulk of the money is concentrated. Everybody and their uncle seems to have NVIDIA in their portfolio, right? So even if you do a dipstick survey today, everybody will say that, hey, I own NVIDIA, or I own some sort of a Mag 7 here or there.
Usually after NVIDIA's run up.
Absolutely, yeah. So you generally come out and say these things when the stock's doing well.
Yes.
So I would say that AI is what's driving the US. There's an AI sort of mania. There's an AI, I wouldn't say bubble, but an AI mania out there. Those 7 stocks are what's driving the US markets. If you want some sort of a performance based on momentum, you would have to have some money there. But I would suggest hold it lightly, right? You never know. There is already a bit of a wobble happening there. People are asking about what is the kind of enterprise adoption of AI? What is the return on investment that you can expect from this $350-400 billion every year that these hyperscalers are spending? Those questions are starting to get asked. I don't have a definitive view. It's the $1 trillion question in the world. That is AI is it going to be, does NVIDIA become a $10 trillion market cap stock, or this finally somewhere the rubber meets the road? So if you want to invest in that portion of that overheated part of the US market, I wouldn't say even overheated, but the well-liked part of the US market, hold it lightly would be my suggestion.
All right. So let's turn to the rest of the world now. If we can begin with the other country that dominates people's minds, which is China. What is your take on two questions that people have about China? Number one, there's a huge amount of political risk. Even if the market has rallied 40% in the last year, even if the market rallies, you never know what's going to happen politically. Possibly the other and related question is on property rights and how much of that story is again driven by a few tech companies. How sustainable is
in China, you mean?
In China.
So let's think about China. Let's take a slightly broader perspective, right? I think 2-3 years ago, there was this entire bogey that China is uninvestable. I'm sure you heard about these articles. People started launching EMX China funds, right? And that is sometimes a sign that you should look at that asset class when everybody is, for whatever reason, trying to say that this is not worth investing. The way we think about China is twofold. One is the fact that it's a $18 trillion economy. It's fairly large and it's growing 5-6% in nominal GDP terms. Our job as investors, and this is me wearing my professional fund manager hat, is to find maybe 8-10 stocks within this whole universe which are growing steadily, do not have the risks of interventions that you talk about. In China, you can never say that this is never going to happen. But broadly, that is the job. And can we find those 8-10 stocks? The answer is yes. We have run a portfolio for 3 years now, which has always had anywhere between 15 to 25% weight in China and has done reasonably okay, right? So is China uninvestable? I think the answer is no. I think that part in my mind is clear and has been clear for the past 3 years. The second question is how to invest in China. I think more than the question, it's important who's answering this question. If it is an Indian investor who's answering this question, which is your audience, I think I would say refrain from taking single stock bets. Unless you are an absolute expert and you follow this really closely. Take a basket approach to investing in China. There are 2 or 3 ETFs, which are again quite popular with most of the investors. Again, views are personal. I'm not recommending any of them, but KWEB is a popular ETF in the US, KWEB, which is the Chinese technology stocks. There is FXI, which is a popular ETF, which is the Chinese large cap names, which is the top probably 50 odd names in China, where there are solid businesses, there are solid cash flows. Yes, there is a risk of intervention, but you're not getting into probably the onshore or the A share market as we call it, and getting into the the mid small caps. The couple of other things about the Chinese market that we need to
to round off that point on ETFs. Yes. There are also index trackers, right? Like I think there is MCHI, which tracks from iShares, which tracks the broader index, and then India has Hang Seng Bs, although because the RBI limit, fresh money can't be put there. But if there are ETFs which track the Hang Seng, for example, is that a good proxy?
It's a good proxy. It's a good proxy to have, but again, as you said, a couple of things in mind. One is fresh inflows, and second, if you're buying an ETF in India, be mindful of the premium that you are paying over the price and the fees, of course, all put together. But China, I think my broad message for an Indian investor who's just starting his or her international journey is that do not do single stock investing from day one, right? Maybe familiarize yourself with a few sectors, familiarize yourself with probably the top 25-30 names, and try and use an index or try and use some sort of a fund management proxy in the middle to get yourself exposure to these things.
Right.
And we know the reasons for this, right? Some of the rallies can be very sharp in China. A lot of the market, especially onshore, is driven more by momentum, more by news flow and things like that. Which is why I would say stick to the top 40-50 large names in China. And within that, the approach that we have followed institutionally is that we have had a sort of a barbell portfolio where we have had dividend yielders. There are companies in China which have 7-8% dividend yield. And as you know, the bond yields in China are less than 2%. So that creates a very attractive sort of an yield option. And these are all largely SOE companies.
State-owned enterprises.
PSUs
of China.
PSUs of China. SOEs I think is also a well understood term these days. Or these are these national champions, right? They are gaining market share globally or benefiting from the Chinese consumption trends, parts of consumption that are growing well. So that's how we have kind of barbelled the portfolio, the steady dividend yield earners, and then some of these companies which are doing well globally. And we also keep evaluating these ETFs, right? The KWEB for technology, the FXI or the index trackers that you keep talking about. I think that's how we have approached China. I would still think that there is a reasonable amount of uninvestable chatter across the globe, but see how the markets have done. I mean, you'll be surprised that in dollar terms, over the last 3 years, the Chinese market has done better than the Indian market.
Oh yes.
Which a lot of people, a lot of even professional investors who do this every day,
they would be surprised.
They'll be surprised to know that on a 1 year basis for sure, on a 3 year basis also, the Chinese market has done better.
Right. Now let's turn to Europe. Again, same story, sort of no growth part of the world, no returns part of the world for many, many years. And then suddenly something happens. Of course, the war happens in 22 and the market just picks up massively. I think defense is the driver there.
Correct.
How bullish are you on Europe?
Yes. So I think the one part of the entire European story is the defense spending, right? So basically, the message is that you have to fend for your own military spends, and everybody has started spending that money. So again, there are enough and more ETFs in the US on the defense/defense allied sort of a theme there. But to give you another part of the story, there is the developing Europe, which is places like Greece, Poland, Hungary, Czech, which is part of our emerging markets union, apart from the Germanys, the Frances of the world, which I find are much more attractive than the developed Europe story, which is this one part, which is the defense part, which is doing really well.
So the world has flipped. The erstwhile pigs have become...
Correct. So this is classically what happens. That's the cycle, right? I mean, it's been 10 years since we had the pigs with two eyes story from 2011-12, which been 13-14 years since then. So one of the best performing stocks in our portfolio has been a Greek bank, and it was a simple story that was available at dirt cheap throwaway valuations. The balance sheet repair had already happened. Nobody had looked at it in like 5-7 years. And I can name banks in India, right, which were going through their entire asset quality issues. They were like hated, nobody liked them. But when that cycle turns, and especially if it is accompanied by sort of loan growth, I think it makes a very potent mixture of low credit cost or negative credit cost and smart loan growth. So I think the Greek economy has been an example of that. Poland is an export champion.
I was just thinking that was your version of buying a Greek island on the cheap. You bought a bank instead.
Yeah, I mean, Greek island was never in the investment universe. I don't even know how to start buying a Greek island. Who do I need to speak to? But I think the Greek banks were quite compelling at that point in time, just from a downside protection standpoint, right? So some of these emerging markets, I mean, I mentioned this earlier, but are still trading at 11-12 PE.
It's insane. People in India would just have a hard time getting their heads around it.
Exactly. So 11-12 PE, people just... So it's like what somebody used to say, that people in Bombay, when somebody tells them that something is available at 5,000 rupees per square foot, they flip. They don't even ask where it is, how it is, what it is doing. So I think something of that sort, right? We are so used to, 40p, we say it so casually.
Yeah.
So which is sometimes the sort of the dilemma that I keep having. I write a note in the morning about an Indian stock saying that at 35p, this looks reasonable. And in the evening, I'm writing a note saying that at 25p, this seems to have done all that it can do. So we should sell this. So I think those are the kind of things that keep happening when you look at different markets. But coming back to what I was saying, that if you have the downside reasonably protected, and I think if you get the growth catalyst, and Greece is an example of that, and hopefully that happens to emerging markets as a whole, you can make really a lot of money in a short period of time.
Yeah. You're also bullish on the European periphery, Poland, you were saying.
That's right. So Greece, Poland, I mean, those are the largest markets on the periphery. On EMEA, we are still watching. By EMEA, I mean places like Turkey, Saudi. So those are the places that we are still, those are the large markets in that region. We're not invested in those markets, but we keep watching them, tracking them occasionally. On developed Europe, I'm not an expert because I don't invest in developed markets, but the defense theme is reasonably strong. And what I said about banks on the European periphery is also generally true for European banks as well, that they have gone through their asset quality repair. But I think the one thing that you have to be sure of is loan growth. Right? Otherwise, you end up owning a value trap where the bank is cheap, making reasonable ROEs, but no growth. You don't want to get into that trap.
Let's turn to the Asian tigers now, Southeast Asia. How does that look?
So within Southeast Asia, let's break this part just to round up the entire world. We spoke a bit about China. I think Korea and Taiwan are tech plays predominantly. So TSMC is, I think, 55% of MSCI Taiwan. So when you're buying Taiwan or Taiwanese stocks, you're effectively buying TSMC.
Yes.
And TSMC is very, very closely correlated with what's happening to NASDAQ.
Yes.
So effectively, you are buying the same trade.
Yes.
Right? So when you're buying the Korean tech names like Samsung, SK, whatever, I think you're just buying the same trend.
Would you say so though? Because they make consumer products as well.
They do, but they behave almost in sync with. So whenever Nvidia had a quarter which was reasonable, but the guidance was softish. But all through when Jensen Huang was talking on the conference call, you should see some of those stocks, right? They are almost following word for word what he's saying. He's saying that this is bad, but the future. So through the day, you can see those stocks. So I think it's just one trade which is manifesting itself through multiple things. You'll be also surprised at a company like Hyundai Electric, which makes electrical and grid equipment. AI is a very small part of what they do, but it also behaves as if it's a tech AI stocks, because that's been the all-pervasive sort of a narrative which has gripped everybody. So Korea, Taiwan is in a way an extension of that. The domestic, they're quasi-developed economies if you look at their per capita GDPs, which means that growth is fairly low. But if you want a tech exposure which is in emerging markets for whatever reason, I think there are some solid companies out there. Coming to ASEAN, I think ASEAN had characteristics which are very similar to India, right? Which is a lowish per capita GDP. Places like Indonesia have a large domestic economy. But you will be surprised at the amount of apathy in those markets. In a place like Philippines, for instance, the daily trading volume of the entire market is $100 million. So you are just left wondering that where do I get exposure? How do I get in? How do I get out? So again, just to tailor the answer for your viewer, I think you can just ignore these for now, unless you find some ASEAN ETF and you find that to be really cheap.
Is there one exception though, which is Vietnam? Seen huge GDP growth.
Yes.
The market has also rallied massively in the past year.
Yes, absolutely. So Vietnam we like at Breakout Capital. It has had this V since Liberation Day because the earlier tariffs were very high, but they eventually settled.
Since Trump's Liberation Day.
Absolutely, Trump's Liberation Day, which is the early April. But it settled at somewhere around 20% and the markets have since. So there's a lot to like about Vietnam, but bear in mind that it is still not an emerging market. It is one level beyond emerging market, which is called a frontier market. So Vietnam is no longer, so there is developed markets, there is emerging markets, there is frontier market. So Vietnam is still a frontier market, but there's a lot to like. I think it's the sort of the last Asian tigers where you become a manufacturing powerhouse and your growth comes largely from the manufacturing side of things. Something that China, Korea, Japan have done before Vietnam. Of the ASEAN, if I were to think about 3 to 5 years, that's the place I would bet on. But again, you have to find a sort of broadish proxy for the market.
Let's finish off this region with Japan.
Again, I think I'll have to duck out of that one because Japan being a developed market, we do not. I have a very broad, big picture view on Japan, but I wouldn't want to give out an opinion on something which I don't do on a regular basis.
Fair. Now, one region that almost never occurs to, let's say, the usual Indian investor who's diversifying abroad is Latin America.
Sure.
We think of it in terms of vacations, but
not even that, I guess.
Yeah, not even that. So, are there opportunities there?
Sure. So again, coming back to the earlier framework that I talked about, right? And Brazil is the largest economy there. Most of the large Latin American markets are single-digit PE markets. Even Brazil is probably 9-10 PE. And what I like about Brazil in general is that it's probably got the highest real rates on the planet. So let me just explain what real rates means. So the interest rate in the country is 15% and inflation is more like 5-6%. So there is a huge scope for those interest rates to come down, and that's generally very positive for growth. Inflation has also come off. I think the realignment of geopolitics means that their exports can now find newer market, especially the agri and commodity exports. So we like LATAM as a region overall, and within that, Brazil obviously is the largest market. There is also a change in politics there. So LATAM, as you know, was the original socialist land, of redistribution.
Now we have Milei.
Absolutely, we have Javier Milei there, who's probably talking the language that every macro investor wants to hear, right? That the government will step back, we will cut the fiscal deficit, we will let the currency float freely. I mean, these are all things that you want to hear as an investor. The jury is still out. So the risk in these things is that you have to sell this to your population and win elections. Right? It's always easy to say that, okay, this is the prescription, this is what we need to do, but you need to also win elections and sell that medicine to people. So the jury is still out on that. We are watching Argentina very closely. It's an experiment. It's a macroeconomic experiment of having to take the hard medicine, and let's see how that comes out. But overall, we like the region. A, starting point valuations are cheap. B, hopefully there is a political change which is more towards the center, if not the right. There are good companies out there which are solid brands, solid franchises.
Anything on Mexico? Mexico was seen as a proxy play on US imports into the US.
That's right.
Now Trump has a wall of tariffs, but not as high as was feared on Liberation Day.
So the entire excitement about Mexico maybe a year ago was about so-called nearshoring, right? That a lot of manufacturing will come out of the Asian economies and get set up in Mexico. So nearshoring was a huge theme till obviously this tariff and all these discussions came about. Domestic Mexico is not very exciting, which is just the domestic consumption or the domestic loan growth, banks, etc. It's okay. It's sort of a middle income economy which is growing 3-4-5%. But I think the entire exciting story within Mexico was this nearshoring opportunity. I think on that we are in a bit of a wait and watch mode. Although I would say President Sheinbaum has managed relations with Trump reasonably well. But we want to see how the MCA shapes up, which is the free trade agreement between Mexico, Canada, and the US. Wait and watch on that one. But if the nearshoring theme is something that we feel confident about maybe 3-6 months later, I think that's something that is worth evaluating in Mexico.
All right. Let's end with, are there particular themes like AI, EV that you guys are bullish on?
So as I said, defense is one theme that we have some exposure in across emerging markets. We have liked gold for a while as a commodity, and which is where again you can get great international exposure through either gold miners or through the physical metal as well.
Gold and other precious metals, silver, platinum?
Gold primarily. Okay. I think because that leads the other PGMs, the precious metals stocks and commodities. So that is one part that we like. In general, we like these smaller EMs, which is the 4 big EMs are China, Korea, Taiwan, and India, which put together are at about maybe 60-65% of the overall MSCI EM. We like some of these smaller places, the Polands, the Greeces, the Vietnams, as you mentioned, parts of Latin America, which have just fallen off investors' radars, we feel. I mean, I speak to analysts there and it almost feels like even they have given up on the stocks and countries that they cover. So I think that's generally a good starting point. You have to be patient about it, but that's where our portfolio is skewed.
All right. So final thoughts for Indians trying to diversify across. You would say follow a basket approach as much as possible?
Follow basket approach as much as possible. I think your default option should be an ETF because A, it is cheap. B, it is fairly easy to trade, get in, get out of. And I think you learn simultaneously as you start investing. And if you're new on this journey, I would say refrain from buying single stocks on day one. As you get more confident about the markets, as you get more confident about themes, I think that's when you should venture into single stocks.
Swanand, thank you so much. It was a pleasure having you.
Cheers. This was great. Thanks, Neil.